Welcome back to the Ask Avidian podcast. This is Jake Borbidge, Chief Investment Officer with Avidian Wealth Solutions. Joining me again today, Robert Palmer, Head of our Financial Planning Department. Robert, I think it's been about 2 weeks since we chatted, which would kind of put us to late April. A lot has happened since that last podcast that we did. The last time we spoke, we were starting to see inklings of a little bit of a market rebound. It was after Trump had tweeted, buy stocks, and then subsequently in the later in the day had tweeted that we come up with a pause on a lot of our tariffs. But also before it came to light that we actually were going to have a pause or a trade truce with China. So last couple of weeks have been very positive for markets, rebounding resoundingly across global markets. That's U.S., small, mid, and large, outside the U.S., debt, everything has been responding positively. The only thing that really hasn't responded too positively, I would say, would be the rates market. So exciting stuff. I mean, what are you taking away from this? How is it affecting yourself personally? What's your stock picks today?
Well, I won't go into my specific stock picks, but what I'll say is I think when it comes to people's 401ks, they're feeling a little bit better now that some of their more passive investments have kind of recapped what they lost at the big dip.
Yeah, you should be feeling better, right?
Yeah.
Hopefully you didn't look, though. Hopefully you didn't look at the bottom.
I just shut my eyes. I knew that as soon as I opened it up. If my credit card wasn't linked to my portfolio interface, I probably wouldn't even be looking at it over the last month or two.
So if you're in a 401k and you're the kind of person that looks at your quarterly statement, you're actually not that bad off, right? Quarterly statement was struck at the end of March. You get that thing kind of midway through April. You were down a little bit, no big deal. April was a really volatile month, even by historical standards. I think we probably made some records. I think we actually did make some records that, maybe not going back to the early 1900s, but definitely going back to the 1980s. I think we had some historical levels of volatility.
Early 2000s at the very least. We had that 7-day winning streak with the S&P.
Yeah. Craziness. And some of the single day moves were, in the 6-7% range. And then some of the intraday moves were, in the down 5, up 7 kind of range, right? So a lot of just, trying to figure out where things are going. However, if you look back at this year so far, or if you fast forward to the end of the year and things don't really move all that much, April's not going to stick out. Like, you would have to go back and research what was going on within the month of April, because we ended the month of April pretty close to flat, down, I think less than 1%. So from a data perspective, if you study market behavior, you look back at returns 5-10 years from now, and you're just studying the monthly returns during 2025, your April is not going to stick out, right? It's going to be one of those things where, like, you had to be there to actually remember the impact. And for most of us, especially hopefully most of our clients, like, they didn't experience the impact. Because hopefully they weren't watching their portfolios every single day.
Yeah, it all smooths out. And I remember one of the things that we talked about is that during those volatile times, in a prior podcast, we talked about dollar cost averaging. This is a great living example of why dollar cost averaging works. If you're worried about the market going down, creating a systematic approach where you're feeding money into the market or into whatever asset you want to buy over time is going to yield a better result for you, because over the long term, everything smooths out.
Yeah, and that April 15th paycheck just systematically bought the dip, and then you're already up on those funds, right? So a great result, not complaining about that at all. It's interesting, though, going forward, right? So now I think we are actually I think we're positive on the year now across most things from an equity perspective. It varies a little bit day to day. But if you look at where we were at the beginning of the year, call it January, very, very low expectation of anything that looked like a recession. Very high multiple, especially on the Mag 7 stocks. What we've seen year to date, Mag 7 I think are still mostly down for the year, but not hugely so. Probably close to low double-digit percentages, maybe 10 to 15%. But the market is up overall, which means there's been a little bit more of a broad participation in the market. Some of the ultra-cheap stocks, some of the safer stuff has started to participate a little bit more with the market rebound. Obviously, the last couple of days have been a pretty tech-oriented market rebound, but overall, I think there's been a little bit of a broadening of market winners, which is not a bad thing, right? And it allows some of the steam to come off of some of those more highly valued names, and also reminds investors that you don't need to own just 5 or 6 stocks to build a portfolio. You want to be diversified, right? So diversification, I think, has actually been a pretty helpful tool so far this year. And so, for our clients, especially the ones that have heeded that advice and stayed diversified, that experience has been a better one than in prior market run-ups where you really just had to own a handful of names to participate.
I was going to make a joke saying, well, not to pull out the crystal ball, but to focus more optimistically on where the market's going. There's still a ton of money sitting in money markets right now and cash on the sidelines that has not participated in the market yet. It's just waiting. And also the fear of greed index, we're not seeing like a ton of greed out there. So the market has rebounded, but investor sentiment hasn't gotten over to the greedy standpoint, and there's a lot of money sitting off on the sidelines. We could be looking at a potential bull cycle that we're walking into.
Yeah, I mean, I think it's fair to say that where in January there were probably few risks to the upside because everything was priced to perfection. Today, price-wise, we're pretty close to where we were at in January, but the level of optimism is much more mixed. You could say if you look at the market rebound in market returns parlance, there is a fair bit of optimism. But if you look at investor sentiment, if you look at consumer sentiment, buying patterns, spending patterns that are kind of slowing with the fear of fear of tariffs and potential recession, there's less optimism there, right? So it's more of a mixed bag of data when you look at kind of the trailing data and the forecast. It's more of a mixed bag, which does give you the potential opportunity of a melt up, right? If sentiment starts to improve significantly, obviously there's some balances, right? The fact that we are in a trade truce does not mean that the trade war is over. There's obviously bad news that could come down the pipe and more good news that could come down the pipe, right? It could swing either way at this point. I think one concrete thing that we can take away is that I think the range of expectations in terms of what's going to happen with tariffs is starting to shrink. If you look at some of our most favored trading partners, I think where they're looking at locking in tariffs, the best deal is probably going to be that 10% across the board tariff with maybe some exclusions around certain strategic products. However, if you look at China's truce, that truce is at 30, right? So if we said the bounds between really good deals and really bad deals are 10 to 30, that sounds a whole lot better than 10 to 200. So when we take that and translate it to how the market views the world, that is reducing that window of uncertainty, which allows the market to start to kind of dial in their predictions around upside and downside scenarios. Kind of starts dialing them in a little bit more tightly. And even though today we have higher average tariffs across the board than we had in January, we have, I would say, less uncertainty around where those tariffs are going to land, right? So, I will call that the glass half full view of the end result of these tariff wars. There's obviously other positive things that could happen later on this year. We're talking about deregulation. We're talking about potential, big, beautiful tax bill. We can be cautiously optimistic that some of those things will happen and that will give the market further reasons to be optimistic. But I think, when you talk about risks, right, there's risks to the upside and to the downside today. So that's something to take away with a positive tilt.
I love working in Trump adjectives whenever describing anything, especially something as exciting as a tax bill.
Yeah.
I did want to actually ask you a question just because it's something that I'm not well versed on. I know that the goal of these
such a long list.
I know it's expansive.
Let's
I know.
Narrow it down a little bit.
But that's why I keep you here on the podcast. So, I understand how these tariffs impact us from a U.S. consumer standpoint. I suppose I'm trying to figure out if they're actually advantageous from an international trade standpoint. So these deals that we're striking compared to the position we were in prior to the tariffs, do you believe most of them are going to create a better outcome for trade for the United States, or is it leaving us in a similar position as prior to the tariffs being in place in the first place?
That is the trillion-dollar question, Robert. So I think, at the very simplest form, tariffs are going to act as friction, right? Mm-hmm. And so in terms of the amount of global trade happening, or that was happening prior to the tariffs versus what's going to happen post-tariffs, greater friction there's no way for it to not reduce overall global trade. However, I think what the outcome that our administration is going for is a more balanced, imports versus exports. So we want to import less versus what we want to export. If you look at the math behind GDP, that actually, just mathematically creates GDP growth. I think in that respect, there is a possibility of the pressure or the influence the guiding hand of these tariffs to guide towards a more balanced trade relationship with a lot of our trade partners. And that's mainly because we are seeing a little bit more favorable terms on products that the U.S. is sending out. Now, the propensity to consume those products in a lot of countries that we trade with, Vietnam, for example, they're probably not going to be buying Ford's, Ford Super Duties or F-150s anytime soon. It's just not something that particular country could afford, right? So you have to look at the buyer's potential to increase their trade or decrease the trade deficit. Some countries just don't have the income ability to do that. Other countries, though, like Europe, I think definitely do, right? So I think we, to the extent that we get on more favorable terms with Europe, that's a possible tailwind for some of the industries within the U.S. But all in, I would say likely less overall global trade, potentially a marginal win in terms of the balance of imports versus exports for the U.S.
Sorry, I was smiling there. I was just picturing a Ford F-150 driving around the UK and Europe. So
it would definitely take up both lanes, right? You wouldn't have to decide what side of the street you're driving on because you're just going to drive on both sides of the street. So not something that we're going to try anytime soon.
Yes, that's probably for the best from a risk management standpoint.
Yeah.
So I want to kind of pivot a little bit because there was another big announcement that took place recently, and that was Warren Buffett stepping down at the end of the year, right?
Yeah, and a surprise announcement too. I mean, I love how he delivered the news, where it was known to a couple friends and family, but not known to the guy that was going to step into the CEO role up until the announcement, and done on live camera, right? So I didn't get to watch that. It sounded like a really, it sounded like the way that somebody had been in the seat forever that can pretty much do what they want to do, might think about going out, right? With a little bit of a bang, with a little bit of a joke, but
it was a great moment. I watched it when it came out, and as soon as he announced it like it was no big deal. Like this was something everybody kind of knew was coming. But next thing you know, as he's moving on to the next sentence, he's just taken aback because the entire crowd stands up and gives him an ovation. Yeah. Like you just see this mass of thousands of people standing up and clapping for him, and he made a commitment not to sell any of his stock, even to when he dies. So it just, I don't know, it was a very moving moment for me because I've been watching him my entire life.
Yeah, so I mean, I'm a big Warren Buffett fan. I think a lot of what we do as investors has been influenced by what he does. And so, there's obviously a large portion of the investment community that just tries to follow and do what Warren Buffett does. And most of them have probably had some, meaningful success because of that. So it'll definitely, I would say it's been a positive influence for the entire industry. He'll be missed. It'll be nice as an investor to not have him as a competitor. So there's always a positive that you can take away from it. But I think the mark that he left on the finance industry is indelible, and it's something that will be around, that'll be written about for decades and generations to come.
It definitely will, without a doubt. I mean, everyone's still reading his books. Everyone's still going through his old YouTube videos and listening to clips. And of course, there's the famous Charlie Munger quotes, which are hands down my favorite quotes. I did have a little bit of a question with this new CEO stepping into Berkshire. Do you think they'll be a little bit more aggressive with their with their cash deployment, or do you think they'll remain true to the course that they've sort of navigated up to this point? Because I know Warren Buffett is constantly being framed as someone who sits on a ton of cash that he could deploy at any moment for a big purchase. Do you think we'll start seeing some of that cash be put to work a little more aggressively now with someone else behind the wheel?
I think it would be highly surprising if the new CEO, Greg Abel, had a very different way of investing and had a different philosophy around purchasing versus holding cash. One of the things that Berkshire has been able to do is be very patient in their investments and not make investments for the sake of deploying capital. That's a unique advantage that most of the investors in Wall Street don't have, right? If you run a mutual fund, you usually are benchmarked to something, and you usually have a tracking error budget, which means if you hoard cash for the sake of making a really, a good value purchase, you run the risk of losing your job, right? So that's an advantage that few people have at their disposal. It would surprise me if they gave away that advantage. They gave away the opportunity to be patient over time. So to the effect of, does Greg deploy that cash today? Does he have a list of, does he have his buy list and he's just waiting to pull the trigger? That would surprise me because he's been involved all the way along, right? So My guess is if they saw a really attractive opportunity, they wouldn't have waited for this surprise transition to make that purchase. They probably would have been working on it. The fact that we've had some, significant market volatility, some stocks that have sold off are still off. That might be a bigger reason to believe that you may see some cash deployment in the near term. But I don't think it would have anything to do with a change in the mindset of got to deploy cash now because I'm the new CEO and I can't sit on it. That would kind of be the opposite of what I'd expect.
Got it. So he's going to be able to do what's right for the company.
No pun intended.
There it is. Speaking of taking advantage of new opportunities that could potentially impact a lot of people, I want to pivot again to alternative investments in 401ks. Now, you brought to my attention that there are some new changes that are taking effect relatively recently where people might be able to get access to that, broader diversification array of investments with alternatives in their 401ks. Tell me a little bit more about that.
So one of the news stories that came out today was I think it was Encore was committing to bringing these assets to 401k plans. It's something that the industry has been working on for decades. It almost, and I've been working on this myself in a prior life. The ability to have private assets in a 401k plan has always kind of seemed like nuclear technology, right? It's always the next best thing is always 10 years away. So it's exciting to see this announcement because, as a wealth manager, as an investor, like we are believers in the private asset space. If for no other reason than we believe that diversification generally is a good thing and having more places to deploy capital that might not act like the S&P 500 gives opportunities for diversification. It doesn't come without risk. It doesn't come without a requirement to kind of know what you're doing. But generally, having more places to deploy capital in a diversified way is a good thing for investors. So it's good to see this coming to 401k plans because, for the majority of the population in the U.S., the majority of our savings as we approach retirement is in 401k plans. So your wealth creation experience for, most of those years is going to be done through that 401k vehicle. And if that 401k vehicle has a less robust set of options than what you can do after you retire, it's definitely not optimal. Now, given that we do deploy quite a bit of capital to private markets, to alternatives, we know that there are a lot of complexities that go along with that deployment, not just in terms of picking the right investment, picking the right asset class. You have to decide what fund you're going to use. You have to think about the vehicle that you've chosen. Not only does the manager of that vehicle matter because they have to be good at picking the investments, but the structure of that vehicle matters too because it has to provide deployment of your capital. But also in the 401k world, it's likely going to need to provide quite a bit of liquidity. Obviously, think of the example of a retiree looking to retire. They get to 65 years old. They've got a couple $1,000,000 saved up in their 401k account. They want to pull it out. If there's no liquidity, that would be a problem, right? So some of those challenges are really why it's been so hard to get private markets into 401k plans in the first place. Robert, from a planning perspective, right, we work with a lot of people that have both, right? They've got a taxable they've got a taxable, brokerage account. They've got an IRA. They've got a 401k. How do you think this is going to change what those investors do?
Yeah, I think it starts with risk management. As you correctly pointed out, adding some diversification could help smooth returns over time. It could also just provide access to something that people haven't generally had access to before, which I think is important, but it's also important to understand the risks. By virtue of not really diving into these things too often or having access to them in the past, they're not well understood. And I think that's a key differentiation between what will be available in a 401k versus what's available at a firm like Avidian, for example. Because I know you and your team spend a lot of time running due diligence on these types of investments to make sure they're the right fit, because we're looking at the whole sleeve of alternative investments, which is a very big world. And what's being unveiled to the 401k is going to be a much narrower version of that field. So that's something to keep in mind when you're planning and trying to manage risk. I think the other thing will be asset staging. At the end of the day, you want to make sure that if you're going, whether it's fixed income or an alternative asset, if you're trying to make sure that your taxable accounts and your pre-tax accounts are balanced in such a way where you have the right kind of mix of equities and fixed income, you're going to want to have the fixed income in the tax-advantaged accounts. right? Because that's going to avoid you having to pay ordinary income tax or additional net investment income tax on those income streams, and it's going to allow for faster accumulation in a more tax-advantaged vehicle. Whereas equities or ETFs that have lower capital distributions, lower dividends, or no dividends, that's going to reduce the amount of tax impact or tax drag on the taxable portfolio, again, allowing for faster accumulation. So I think asset staging and risk management are the two parts of planning you want to consider when you're looking at alternatives.
Okay. So if we're talking to 401k plan sponsors, right, those are going to be ultimately the individuals, the CIOs that have to decide, okay, do I include this private investment in, the list of investments that are on the 401k plan, and how do I go about including it? What are some tips that we can give to those individuals as they're kind of as that responsibility is now thrust on them because this new window of opportunity is opened up?
Yeah, and I would be surprised if what they should be doing isn't already very well articulated in the regulations around the unveiling of alternative asset access in the first place, which is just disclosure. Normally whenever you want to buy a fund or something, a prospectus needs to be available to the purchaser of that particular mutual fund or ETF so they understand what it is they're buying. Alternative assets require a little bit more due diligence because they might not know everything that's out there. And so it's usually a thicker form that you have to get through and a few other channels that you have to go to. My guess is that this is going to be a much simpler process than what you and your team have to go through. So I think the sponsors are probably going to have a nice consolidated disclosure form that they'll send out to their clients. Their clients will have to acknowledge that they've read it and understood it, and they're willing to accept the risks involved with that alternative asset. And I think at the end of the day, the best thing the sponsors can do, besides making sure there's proper disclosures in place, is having some kind of articulation as to why this could be a good fit within a portfolio and when it would be a bad fit in a portfolio, and boil it down to brass tacks.
Okay. I think the interesting thing too is you got to think through what's going to be the most likely private funds or private products that are going to show up in a 401k plan. And if I had to tick through the list, I think the first one is probably real estate.
I was going to guess real estate.
Real estate is fairly straightforward and one of the more easily understood asset classes in the private space. And none of them are super easy. The next one I would probably say is credit, mainly because of the risk profile is a little bit lighter on the risk profile. I think those are two that are a little bit of a head scratcher, right? So most individuals in 401k plans, their biggest individual asset already is their house, right? So the real estate, is it actually going to bring diversification? Maybe, maybe not. And then on the real estate side, that actually is, of all the private assets, the asset class that has probably had the most headwind. It's been struggling over the last, I think it's going on 5+ years now. So an asset class that when you look at the offering on the platform, the returns are not going to measure up to what you got in public equity. So how many people are actually going to make that election to go into the private real estate fund? That's obviously TBD. Like you're talking about on the credit side, it's more advantageous to have your credit exposure in the tax advantaged account, right?
Absolutely.
So that one kind of makes a little bit of sense. You might see that yield advantage over, a publicly traded high yield fund or even investment grade bond fund. It's a substantial yield advantage. So that one, if you do the math on the taxes, there's a fit there. I don't know how often 401k plans present the after-tax versus pre-tax results, right? But that would be one where if you're taking a holistic view to talk to a client, you could say, well, maybe you do the private equity or the private real estate in a taxable account and do the credit over here now that they've offered it, right? So it's an interesting, game of expertise to try and go through. We'll see what happens. We'll see what actually makes it into these plans and what the uptake has been. Last thing I think that we might want to touch base on today, just some interesting things coming out. The president is obviously taking a tour through the Middle East right now. He was in Qatar, or Qatar, as I've heard it referred to in the energy space over the last couple days. I believe he's in Saudi today. So some interesting news stories. We're not going to touch on the who gave who an airplane, but I think it's worth talking about just the amount of potential investment coming out of that region. And if we take the social side out of the equation, if we take the political side out of the equation and just think about the potential for capital flowing from that region into the U.S. to invest in things, and how, from the perspective of call it the QIA, how much sense that makes when you look at the revenue that they generate. What drives the most of that revenue, obviously, is the energy sector. You could look at them as a really, really large institution with a really concentrated revenue source or a really concentrated position in energy, trying to diversify out. If you look at that behavior, you see they're diversifying out in a lot of the things that we look at on the private side as well. And they do a lot of private investing. Sports teams are one of them, right? They bought one of the premier sports leagues in Europe. I don't know soccer, so I don't know the name of the team, but it's a big one, and apparently they're kind of good. So they've made some investments in the sports side of things. They were very early on. They tend to be pretty good at investing early on into some themes that actually do gain traction. So very large allocations into the AI side of things. So that's something to keep in mind. And so, it's interesting, I think, to U.S. investors, because what our administration is out doing, again, take out the political side of things, they're providing new avenues for capital to make it to the U.S., to U.S. investments, to U.S. corporations. And when we look at that from an asset allocation perspective, it does continue to affirm our confidence that the U.S. equity market's actually a pretty good place to be, and really it's less to do with the U.S. consumer, and it's more to do with the stocks that end up being listed on U.S. equity exchanges. They don't have to be the best U.S. companies; they have to be the best companies in the world, and that means that the exchange in the U.S. has to be the best place to raise capital. So I think that's something that we've seen. Obviously, the most advanced technology companies have come to the U.S., right? AI, mostly U.S. based. Not to say that the intellect or the expertise is all based from U.S. Engineers or U.S. coders, but where those companies are launching, it tends to be in the U.S. just because it's a good place to be a business owner. So that's positive. I think it's something to continue to look forward to as a U.S. resident, as an investor in the U.S. equity space, and especially in the private equity space, which does tend to be fairly U.S. centric.
All right, Jake. Well, thank you so much for summing that up for us. I really enjoy learning more about the market rebound that's taken place recently, Warren Buffett, and of course, alternative assets and 401ks.
Thanks, Robert. It's been fun. Again, if you guys want to get more information or just come connect with us, check us out at avidianwealth.com.